Hi, I'm Hedgeye founder and CEO Keith McCullough. I'm excited to announce the Hedgeye on the Prize tournament. I challenge you to compete in this simulated investing tournament to win some serious money. We'll be awarding weekly and monthly cash prizes along with the big grand prizes. Along the way, we'll teach you how to take your investing to a whole new level. I hope you'll join us. I'll be coaching you every step of the way. I'm Keith McCullough, and welcome back. Thanks for letting me grab some lunch. In fact, I think everything about that lunch was inflationary. There were everything in there. I think there was some palm oil in there. Cheese prices were up 8% last week. It's what everybody's talking about. Grant, welcome to the summit, and thank you for making the time. But I'm inflating. I feel like I'm inflating personally. Just if you could see my belly, you would believe that. What do you think, man? Do you spend enough time talking about that?
Yeah, look, I mean, I don't think any of us have a choice at the moment. You know, for the last year, every conversation I've had has at some point seemingly gotten around to inflation and deflation. It's the one thing that on the podcast I've been doing has just raised its head again and again and again, and for good reason, right? Because we've had 40 years of deflationary tailwinds. And I'm in the middle of writing about this right now. And if that does change, and look, it's not certain that it will, but with every day that goes past and every crazy rise in costs and bottlenecks that transpires, the odds increase that it will change. People have a massive set of decisions to make. You know, everybody's portfolio is set up for a deflationary environment. And if we go into an inflationary environment, it flips everything on its head. So I think it's the one thing that everybody has to have a view on and has to think through right now and have a plan for if it does turn out to not be transitory, as the geniuses at the Federal Reserve assure us that it is, although their confidence seems to be wavering a little bit on that recently.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content. Yeah, I mean, it's an interesting point, and it's just the fact of the matter is if you don't have a point of view on inflation, you're going to have a tough time running assets or having a view on how to protect and preserve your own net wealth. I think one of the more interesting ones where I had the notes on your podcast was with Sam Zell, I believe. And he, is that correct? Am I remembering the right one? Where you had a conversation with him, where he digs into, I mean, I actually think that at this point, trending inflation, it's almost nonsensical. If you've either been long of it for the last year and a half or you're not. So from my perspective, that's not really the debate, when to get out of it and when the behavioral realities of inflation. That's what Zell talked about, which is the psychology of inflation expectations. We have plenty of charts on those, but what did you think about that?
Well, he talks about it being a mindset, and he's absolutely right. Inflation is a mindset, and that's really that's the tipping point. Is when it becomes entrenched in people's expectations that inflation is not going to be transitory, or if it is going to be, not 2%, not 3%, but 5% and 6%, and potentially keep climbing. That's when people adjust their behaviors, and once you reach that stage, that's not something that the Fed telling them it's only going to be for a couple of months is going to change. That's not the thing that a small rise in interest rates is going to get under control. So this explains why there's so much time and energy devoted to jawboning about expectations, and why you see the word transitory used so often. Although noticeably in the September Fed minutes, it wasn't mentioned once, down from I think 9 times in March and 6 times in June. September, the word transitory wasn't used once, which is an interesting kind of peek behind the curtain. But Sam's point was well taken. Here's a man who's been, he's always announced as investor, billionaire investor Sam Zell, but he's a businessman. He's been running businesses for 50 odd years now, and operating them. And so he understands this from a business practitioner standpoint, not just from the perspective of financial assets. Mm-hmm. And it's completely different. If you run a company, inflation is a major problem for you, particularly if you can't pass those costs on to your consumer. And with the stresses in the economy post-pandemic, even though all these stimmy checks make things look optically perhaps better than they are, the pricing power that producers have over consumers is very small right now. And so this is something that companies all around the world need to have a plan for, and so do investors.
Well, it's interesting, just trying to dig up the charts while you're saying that. I mean, the best part about these conversations for me is that it triggers something that's locked in my thick skull somewhere. But on the Fed not talking about it, and Powell actually reducing it to almost a scarecrow at the Jackson Hole meeting. Remember when he used used car prices, which is such a small component of headline CPI. New cars is a two-bagger on that, and they're inflating, as far as the eye can see, just to put one point in the coffin if you need that, or one nail. But slide 37, on their own nowcast, it's ripping, right? I mean, on their own surveys on slide 38, which is rent price expectations, which Sam Zell would absolutely care about in any real estate investor. This is the New York Fed survey of consumer expectations, and note how far back that goes and the nothingness that it did before. I mean, so where are we at on that? We can get into the bean counting and why, if you get rent right or you get home price inflation right because it leads rent, how it actually and almost is mathematically impossible to get inflation much below 3.5 to 5 anytime soon. What is it about the Federal Reserve? Is it negligence? Is it just political? Is it ignorance? I mean, what is it?
Look, we've gone backwards and forwards about that for a long time, and I think the simple truth is at this point it doesn't really matter. What's happening now is really a battle for control. We have a financial system that is spluttering. It's at or near the end of its useful life, and when those things happen, things tend to go wrong. It's if you're driving a car and you get a blowout, the first thing you got to try and do is get control of the car again. And that's really what we're seeing here, whether it's financial control of markets that aren't necessarily doing what the Federal Reserve needs them to do in response to policy and response to the kind of jawboning they do, whether it's government control over spending, whether it's government control over the population, whether it's government control over anything. We have a system which is reaching the end of its life. And so this has become a battle for control. You showed that chart, Keith, of rents, and it's interesting because I know when you were talking to Ben Hunt yesterday, you mentioned Dave Rosenberg, a mutual friend of ours, and I have a tremendous amount of respect for Rosie. And Rosie came on the podcast with Steph Pomboy and I and talked about this and was adamant that deflation is still the problem. And one of the points he made was until you get rent inflation, serious rent inflation, this is nothing to even talk about. We've seen Zillow are talking about 10, 11% inflation in rents across the board now. And one by one, these kind of outliers that the people who remain on the deflationary train have been pointing out as the things that we really need to focus on before there's any chance that we're going to get sticky inflation. One by one, they're kind of falling by the wayside now. Mm-hmm. So while it's still not baked in the cake that inflation is a given, the longer this goes on, and when you see 8% PPI prints and CPI prints in the high fives, maybe low sixes, when you see German CPI at 30-year high, there's a country that's very sensitive to that, and you see all the crazy stuff we're seeing in energy, and net gas up 120 odd percent year to date, and oil up 70% year to date, and that's before the winter gets started. The major inputs for inflation are all proving to be very, very sticky in terms of price rises. So I think that rent is an important, shelter is the biggest component of the CPI. So as you say, if you get shelter inflation, it's very, very difficult to get a low CPI print. What's going to be interesting is if these things carry on, what are the words going to come out of the Eccles building? What are they going to say to try and change that mindset that Sam Zell spoke about? Because it's not easy to do. It's easy to do when you're forecasting the stuff and it's in the twos and you're worried about it might get to 2 and you can talk about it running hot. When it's at 5, it's a lot harder to change that mindset. So I think we're at a very critical point here in terms of how the data comes through and how the Fed manage changing expectations on the part of consumers.
Yeah, so let's unpack that. So on the one side, you have the permanent inflationistas versus the deflationistas. I've been neither. I think if you want to make money over time, you trade the cycle of inflation and deflation, and you'll do much better. And the data that, to Grant's point, the slide that we used yesterday was slide 47, and we showed a nowcast of every American city MSA that is showing rent inflation on the order of, in Tampa Bay's case, we called out 30%. But I mean, and those are August numbers, which are lower than the September numbers that we just got. But so that's on one hand. Like I actually, at this point, Grant, I know, we know what certain publications are going to say about inflation, what certain publications are going to say about deflation. If you want to be in the deflation camp, you cite Lacey Hunt. It has nothing to do with having respect or no respect for individuals. It's just like our job in the market is to get inflation or deflation right. And that's, so on the other side, I'm more interested in the cover your ass, exercise of politicians who are always late and lagging on inflation or deflation. And now, to your point, with a third of the CPI being rent, it's unequivocally going to be not transitory in the next 6 months, which for a lot of people, I actually think in the next 6 days, a lot of people struggle with what to do with this market, never mind 6 months from now. So how do you think that that's going to play out at the Fed and policy? Do you have a view on that?
Well, it's interesting. You said a couple of things there that caught my ear. The first thing was about trading the cycles and being neither a deflationist or an inflationist. And I think the advantage we've had is that for 40 years, you haven't really had to do that. You could have been a deflationist, right? For 4 decades. And you had a few periods where you were kind of, loosening your tie a little bit, but you've been right. But what's happened in the last year, and Lacey Hunt has been the most stoic, the most staunch about that thesis for the longest time, and he remains there with one caveat, which I'll come to shortly. But you've seen people like another good friend of mine, Russell Napier, and we had Russell and Lacey on the Endgame podcast, Bill Fleckenstein and I, back-to-back weeks several months ago. And it was fascinating. Lacey, as I said, remains staunch in his belief that deflation is the problem. Russell, who has been in that camp for a couple of decades now, is now switched 180 degrees into the inflation camp, again, for reasons which I'll kind of parrot in a second. So we are definitely at an inflection point where after that long period of being able to stay in one camp and for the most part have a pretty smooth ride, we're in some choppy waters now. Lacey's point was absolutely adamant that this is deflation is the problem you have to worry about, except for one thing. And he talked about the fact that if the Fed was suddenly given the power to spend as opposed to just lend, i.e. they can turn their balance sheet into spending power, he said, then we would get very rapidly, we'd get high inflation. And Russell's point, and the reason Russell stepped off the deflationary train and very staunchly onto the train going the other direction was the bank credit guarantees that were put in place in the teeth of the pandemic last year, where the governments have basically said, look, we're going to give these loans and we're going to get the money out into the system and essentially we'll forgive a lot of these loans. We had the bounce back loan in the UK, we had the CARES Act in the US, and right across the kind of developed world, we saw these bank credit guarantees put in there. And Russell's view of that was, look, we've always had this massive debt, but we've had a lot of debt without them being able to create more money. Now they've been able to create more money. And the two of them, they're not quite the same, but there is a link that connects them with potentially a central bank digital currency that allows this final leap to happen. And if we see what's going on with the central bank digital currencies, and Doomberg on Twitter put out a great piece about this. I think it's called Dystopia Coin. I think he put it out this morning, just connecting some of those dots. And it's absolutely true. If we do get a Fed coin, which, again, if we come back to that battle for control, nothing gives the government more control than some kind of digital currency. They can absolutely direct where, how, and when it gets spent. So if we are in a battle for control, as I suspect, that is one of the ultimate controls they can exert. If that happens, it's very likely that you'll see people like Lacey Hunt after 40 years finally say, okay, cry uncle, wave the white flag and say, this is what I was worried about. This is the problem where the Fed can start spending money and inflation is now out the bottle. And at that point, kind of all bets are off.
Yeah, as is always the case, you're speaking across big cycles with specificity. And if somebody's listening that isn't It doesn't have the cycles emblazoned in their thick skull like I might. Well, why is Lacey Hunt famous for deflation? Because he started making the call and came into this business. Like, we are all so lucky. I mean, we're largely a function of when we come into this business. Don't forget that if you're a good analyst, you have to make the call when God put you on the earth to make the call, right? I mean, he didn't put you on the earth to make the call. It's the time that you are analyzing. So in 1981, obviously the 10-year yield was, I believe, at 15.8% or thereabouts, 15.3%. And from 1981 till 2021, okay, voila. I mean, but there have been plenty of inflations in between. Again, that in this day and age, for me, doing what I do, that's not nearly enough. I can't park it and say, here's my 40-year call. That's not what I do. I think it's much more engaging and interesting to be fighting the fight on inflation, reflation, deflation, disinflation every day, because you can make a lot of money doing it. So let's just start with that. But let's just say we get, so I'm going to sell all my commodities at some point and say, look, we're going to have a disinflation. That's what my nowcast says against Q2 of next year. So it's not like I'm going to turn in the world's greatest deflationista. It's just that my nowcast, which you can already see what I'm going to do, but it's when I do it that matters. On slide 15, it's just going to step down like 200 basis points. So when everyone gets used to, and that's my point about the Fed, like once everyone agrees to agree it's going to be 5, don't forget that those Q1 numbers, which are going to be actually front-running my own model, they'll be above 5. Will be at some point those numbers will be at some point February, March, April of next year. Right, so I still have a couple careers from now, between now and making the switch. But when I make that move, the biggest risk to me is what you just said. If I sell all my commodities, buy treasuries and buy gold, which is exactly what I'll do, then I got to deal with MMT on the other side of my ass. That's a major issue. Like that's an issue no one in 40 years or in my 22 years has had to deal with. MMT, digital coins, I think what you said is that those will, if they'll even turn Lacey Hunt, then they must be inflationary.
Yeah, I mean, look, it's the problem here is when you reach an inflection point like this, it becomes much more important to get the right call, right? And whether that's a short-term call or a long-term call, the fact that so much of this is psychological. It makes it really, really difficult to look at the data and forecast inflation and what will happen based on the data numbers. Because, look, the CPI numbers have had a somewhat tenuous relationship with reality for the longest time now. I mean, every adjustment that's been made to them over the years, and there have been plenty, has never, ever resulted in a higher CPI number, right? They're always brought in to lower the CPI number. So the Fed have kind of tried to get the lowest CPI number they can to ease the burden of COLA adjustments to Social Security payments, etc. Now they find themselves at a point where they've been talking for years now that we're going to get to 2%, which they've made as hard for themselves as they possibly can by the way they've set up the game. And so being held to that 2% on the upside has led them to have to overshoot it. Then they started talking about, well, we're going to let it run hot for a while. Okay, but that, again, they didn't talk about how long that would be and how long the average over time would be. But when you're trying to make these calls, Keith, you're dealing with psychology here. You're dealing with not only the psychology of consumers, but also producers in terms of what they think is going to happen to their input costs over time. Do they start front loading to hedge those? And you're talking about the psychology of people listening to the Federal Reserve who, again, you've got to say that their credibility, as fragile as it's been over the years, in terms of if you look at their calls and how often they've got them right, which is as close to zero as you can get. As that credibility goes, it means that when they do start to try and talk people down from the roof, people listen to them even less. So, whichever way this goes, we're in a very dangerous point right here, right now. And for investors, again, I've said this before, what we're talking about here is don't just assume that the past 40 years is going to continue. That's a very dangerous assumption to make, particularly when rates have gone down to zero, indicating that they've kind of reached the end of that journey. B, don't assume that it's going to go straight to inflation and you have to make inflation hedges for hyperinflation, because that's, again, a dangerous assumption to make. Understand you're in choppy waters and look at what can hurt you. Being long a whole bunch of bonds down here. And if you look at Russell Napier spoke about this period between 1942 and 1951, post World War II, when the Fed capped the yield curve. And Stephanie Kelton refers to this in the deficit myth and talks about what a great policy it was and how we kept the yield curve nicely capped and it worked. So therefore, why wouldn't it work next time? And as Russell pointed out, there's just a couple of tiny little points that weren't mentioned. One being that the country had capital controls, they had rationing, they had price caps, and they had capital controls. So yes, you can keep the yield curve down if you put all that stuff in, if you force people to hold government bonds, or if you commit to an unlimited expansion of the Fed's balance sheet, all of which are massively inflationary. So it's possible that they could make good on this and say, well, we're going to cap the yield curve and we will keep low rates and we won't get high inflation. And people sit back and listen to that and go, well, that would be a perfect outcome. And I guarantee you it would not be a perfect outcome because there are other things that will have to be put in place to make those two strategies effective. And they will result in you being mandated in what you have to hold, and it will be treasury bonds. And Russell pointed out that a similar period in the UK where people who've been forced to hold bonds lost 85% of their purchasing power. So we're at a very, very dangerous juncture here that you need to have a plan for, and you really need to read some history and understand how periods like this have gone in the past and what the potential things you're going to have to solve for, because they're not simple and they're not straightforward and they're not small issues that we've had to deal with in the past 40 years.
What's interesting about that too, that economic outcome, if we push out time and space, that to me is what I call quad 3 stagflation. Currently I'm long quad 2, which is a reacceleration post-COVID which is a big nominal environment. But if we actually were to get into that economic zone, 1970s style stagflation, which gave birth to the 15.8% 10-year yield in 1981. You can cap whatever you want in terms of bond yields, but that doesn't mean that the world's going to go your way, economically or asset management wise or otherwise. I mean, that's kind of a crazy thing to think. Back to the point though that you made on the Fed's never really seen it coming. What's interesting to me was this, and we put it in. First of all, slide 39 and 40, guys, just show them quickly. To Grant's point, it's a third of the CPI rent. Where is it now? Where is it going? We all know where it's going. We're just front running our own model. So that's how I get to 5-6% headline inflation, is that they just take the shelter component up because home price inflation leads that. That's why we're doing every city like I showed. But on slide 41, this is kind of nutty, is that they already have the white paper done. Right? This is telling you what I just said, which we've said since the beginning of Hedgeye time, which is OER, or owner's equivalent rent, is front ran by home price inflation. So now even the Fed knows that, but the Fed doesn't talk about that. Like, what the hell's going on? I mean, this is suggesting that a third of the CPI goes to 7 or 8%. Okay? A third of the CPI goes with a high probability, which we'd agree with. So what is going on there? And I understand that Kaplan, he left for other reasons, but how does the head of the Federal Reserve have this in his back pocket with one of his senior guys in one of the senior offices for that matter, and not talk about it and talk about used car prices?
Well, look, again, you have to understand the overarching theme here is that control I've talked about, right? It's control and keeping things together at this point. So the Fed has to have, kind of a united front out in public, which is why you're hearing this transitory word being uttered so often and by so many people. This is the narrative, right? We have to convince people that this is transitory. We have to stop them worrying that these price rises are going to continue into the indefinite future, and they will have to mitigate those by front loading and chasing prices and chasing goods off the shelves, particularly in a time of bottlenecks and supply chain issues and all the things that we've seen. So you have to have that united face. If one of the key weapons in your arsenal is the power of jawboning, you have to present a united front. And it's interesting that today, I think it was Bullard, I'm not sure, one of the Fed talking heads came out and was ever so gently starting to talk about the CPI being higher than they thought for a longer period of time. But if you listen to the language, it was very much, well, yeah, it's up, and it may persist for a little while, but don't worry, it's still going to come down. So you can already see a change in what they feel they're trying to battle against now. It's not a question of convincing people of a story anymore, which it was with the whole, we're going to let it run hot, we're going to convince you that it's going to go up to 2% and maybe 3%. Now it's a case of we've got to dissuade you of a notion that it's going to be 5, 6 for a year, and maybe go to 7, 8, 9, 10, who knows? So now they're playing defense. Playing offense is one thing, and saying, here's what we want to condition you into thinking. A, it's transitory. B, it's going to run hot for a while, but here's what we want you to think. And we're going to keep hammering this to you so that we get you on board with us and you're thinking the right things. Now it's a case of, okay, we don't want you thinking this. Here's how you should be thinking about it. But to do that, you've got to disavow them of these notions. And everything that they're seeing in the grocery store, particularly as we come into the coldest part of the year, when people's electricity bills and power bills are going to go up, particularly when we're coming in the US, we're a month or so away from Thanksgiving, when people want to go out and spend a lot of money on food for big family gatherings, if they're allowed to have them in their home. I think the easiest thing is to have 30,000 people around for Christmas lunch. That's okay, apparently. But we are going into that part of the year where the costs that people have to pay are going to become very, very apparent to them. There's no stealth about this. And so, again, you've got to try and find a way to preempt that and get the idea in people's heads that, oh yeah, I've had an expensive couple of months of power bills, but someone told me it was going to be 5% for the next few months, and then that's a very difficult trick to pull off.
Yeah,
because
people
are struggling enough already.
That does not work, and I think given all my faults, which are manifest in doing this job or trying to get things less wrong than right. Growing up in a family where that's reality, like where the things we've talked about, your rent or mortgage, food and gas in the car, that's it. I mean, anything that's left after that is a bonus. I just don't think that Wall Street speaks that language, never has, never will, but it doesn't change the massive level of disgust and distrust that people already have of the government, never mind when they know bloody well, like this is, like I mentioned cheese at the beginning, like in the Chipotle thing, and I'm full blown loaded to the gills. Almost anything you can buy that's liquid in futures and options contracts, ETF or otherwise, in commodities, cocoa, things I've never bought before, just because it was so obvious. But I'm mad at myself because I don't own the cheese that we need to own, to your point, for Thanksgiving or for, you said Christmas lunch, but our Christmas Eve in good Irish Catholic faith. I mean, I'm going to have to pay more for it. I should have just bought, everything I was going to buy, and I didn't do it, and I knew about it. Wait, what about everybody else? I mean, it's going to be really interesting to watch the behavioral component of this. And what's the only thing I'm certain of is that the Federal Reserve is going to look like that they've lied to people. And that's a major problem, in addition to the issues that they already have in terms of insider trading or front running or not. What do you think? Do you think that they are at the point? Like a lot of us, I'm a Fed critic, obviously, but I think for the right reasons. At this point, you can't analyze anything, and you're front running with your own PAs. I mean, if the Fed was ever at the wrong spot in terms of public distrust, where I got them, it's now.
Yeah. No, I think you're right, and it's interesting because you talk about what you talked about there. Wall Street isn't the real world, and so Wall Street tends to look at. There are two problems. One, we tend to look at everything as a data point and as a chart, and we extrapolate them, and we look at the pictures, and we try and figure out where things are going. But they're numbers on charts. One of the things about Wall Street is that it's provided people with a standard of living that means that the kind of marginal inflation is something that they notice, certainly, but it's not going to change their behaviors necessarily.
Right.
At the higher echelons of Wall Street, that super yacht goes up 10%. Maybe you end up not buying another one. But in terms of grocery, you're going to feel the pinch and go, wow, this was really expensive this year, but it's not going to change behaviors. However, that changes very quickly. As you move down the socioeconomic curve, it becomes a huge problem. We're talking about food here, right? We're talking about food and shelter, the basics, and power. And so, the Fed find themselves at a place where do we want to be looked upon as lying to the public, or do we want to be looked upon as incompetent? And we got it wrong, blatantly wrong. I mean, it's a tough choice.
Well,
It's a tough choice.
I mean, but this flipped in the night. And again, I'm not saying it's the 1970s. I'm saying that there's a flip coming because there is no data to support the prior premise. Zero. So, and it's not just the Fed. I mean, I was just looking up this guy's name. This guy Brian Deese, who made plenty of retweet waves on my handle when he said it. He's the head of the National Economic Council at this point. Younger guy. He's like, well, if you back all that stuff out that you just said, Grant, including food, there's no inflation. What are you talking about? But he's he's a Democrat. Obviously, but there was a flip, right? I mean, this guy looks like he's unequivocally partisan, obviously, but unaware maybe and willing to say anything. But in the 1970s, it changed, right? Like the same guy with the same job in the Nixon administration was a Republican instead of a Democrat. And I don't know if it matters what the difference is. Would call inflation a hydra-headed monster that will not go away. So that's what I'm wondering. Like, is that actually going to be what these guys have to flip to say within 6 months? I doubt it, but that would be interesting.
Well, think about it. What it comes down to are votes, ultimately, right? That's what all this comes down to. And if inflation is the thing that is potentially causing the most people to flip their vote, then it will have to be tackled. And it will be called a hydra-headed monster. And it will be something we have to get under control, right? Because you're pandering to the people that you're hurting the most. And that's one of the big dangers here, not coming from the Fed, but coming from administration. And with the Powell reconfirmation hearing coming out and all the stuff coming out about Kaplan and Rosengren and Clarida and all the stuff that's going on, which, look, any of us that have spent any time in this business know whether they can technically do what they did or not, it's wrong. We all know it's wrong.
Yeah,
it's not morally right, and they should and do know better, frankly, right? There's no argument about that whatsoever. And they can point to the regulators and say, well, technically, no, bullshit. I'm afraid that's just not right. Yeah. But when you've got these problems and you've got an administration that is desperately trying to bring in a much more progressive agenda, they're flirting with MMT. They want to, they're looking at $3.5 trillion stimulus check. You have an opportunity here to remake the Federal Reserve in the way that the Trump administration remade the Supreme Court. And I would argue that having the right Federal Reserve Board is way more important, particularly in the short term, than having the right Supreme Court. These aren't lifetime appointments, but you get the right guys in at the right time, and you'll be amazed at what kind of progressive agendas you can get through the Federal Reserve.
That I have not thought of that at all. But if you want to be a real conspiracy theorist, then they all knew all along that they were going to put up their hand and say, I'm out. So you get those people in to their seats.
Look, let's not even call it a conspiracy. Let's not even label it a conspiracy. Let's just say it's pure fluke. Doesn't really matter. The timing is either well chosen or it's very helpful. It doesn't matter which.
Yeah, it's opportune.
But you do have an opportunity now potentially to stack the board with dollars.
Wow, that's a good point. Really good point.
Look, that will change everything in terms of inflation. You can expect A, inflation to pick up much faster, and B, the measures that they have to take on the other end of it to get it under control to become that much more draconian.
Yeah, I mean, think about that. Think about what the Fed could look like, within less than a year from now. You'd be Lyle Brainerd instead of Powell, joined at the hip with the Treasury, with who she worked with prior, which is Janet Yellen, and then instead of Rosengren and Kaplan, you have people that are like, oh, I would never trade. I'm doing this for the better good of humanity.
Yeah,
like this. Yeah. This is, oh God.
Yeah, look, I mean, it's a strong possibility at this point. And like I said, I think people realize now, people in government realize that having a compliant Fed is arguably the single biggest tailwind you can possibly have. Yeah. So, maybe we should just turn the Eccles building into a giant dove loft and fill it full of them. But I suspect that's going to be the thing that we have to watch out for.
Well, I mean, I don't think that there's a chance, and I certainly wouldn't put any money on it, even as an outside chance that Powell is going to be back in his seat, given what just happened with, 3 of his senior guys getting nailed and him signing off on the investigation. He should investigate himself. He bailed out his own position in municipal bonds, and then was asked about it. I don't know if you saw that the other day, under oath, and he just waved it off. Like, I thought, that I called compliance and they said it was fine, but it wasn't fine, Jay. It was and he knows
that. Look, Keith. I mean, he knows that, right? This is we are post-consequence world, unfortunately, right? That's what we inhabit now, and the kind of brazenness of all these guys is rooted in years of there being no consequences for any kind of malfeasance. You on the same day you read about Kaplan and Rosengren, you read about a Citibank trader having to disgorge 6 times the profits he made from an insider trade where he made 36 grand or something. It's laughable, but people in power just have that brazenness now that, you know what, there won't be any, and if I get caught, nothing's going to happen to me. I'm too important, I'm too powerful, and I can just brazen it out, and I can resign and go on my way. I mean, the fact that Kaplan and these guys were trading like this when I forget which one, I think it's Kaplan, is already supposedly a billionaire, and he's trying to make a couple of extra million by trading in and out. I mean, it's a really bad look at the very best. Right?
I thought I said this yesterday with Ben, but I mean with Ben Hunt, it's like, it's just the way, the fact that he couldn't find it within himself to say, I'm sorry, I was wrong.
Yeah.
Like let's just start with some leadership qualities like that in this world. Just apologize when you're wrong, say I shouldn't have done it. But that of course isn't going to happen because there's no consequences. But it does take a certain kind of a human being to not acknowledge their mistakes and not try to evolve every day and just be a better person. I guess that's just not, you're not going to be in political office these days if that's you. But
it takes the kind of person who would do it in the first place, is the simple truth.
Oh, there you go.
They're the same person.
Well, that's what I always say with people who steal other people's things or do bad things. It's not like they're always, really, feeling bad about what they did. It's just they're upset that they got caught. I mean, it's, it's what it is. All right, we have some time for some questions here, and I want to get into that. Here's a great question that I haven't asked you. Obviously, it's the top-ranked question from Paul. If the relation between gold and real yields is still valid, why does gold perform this environment of an inflation scare?
It's funny. Anytime you ask a question about gold that starts with the word why, you might as well just go, It's one of those things, right? It's not a short-term asset. I mean, this is a 6,000-year-old asset, right? Mm-hmm. And it tends not to do in the short term what you think it'll do, when you think it'll do it. But say if you look over long periods of time, extended periods of time, it does. If you've owned gold since 2000, for example, when it became clear post the dot-com bubble that the modus operandi going forward of the Fed was going to be just cut rates. If you just started buying gold then as a protection, it's done phenomenally well. Until I think this recent laptop, it was outperforming the S&P for those last 20 years. And I think 20 years is a fair time frame to pick, and everyone can be accused of cherry picking time frames, which is absolutely fine. So I think if you're in gold as a trading vehicle, that's completely different. If you're looking to trade gold and you're looking at the charts, you're looking at the technicals, that's one thing. I would suggest you spend more time looking at the positioning on the COMEX than anything else if you want to trade gold. Look at the speculators, look at the commercials and non-commercial positioning. That's to me, if you were a trader, that's arguably the biggest tip you can have. But if you are looking to own gold to protect your portfolio, then you're going to kill yourself looking at it on a daily basis and saying, why hasn't it protected my portfolio today?
Yeah.
Because there are going to be days when it doesn't. But if you say over the next, if everything we've talked about, you hold some store and you think, okay, inflation is a problem that I think I need to worry about for the next 10 years, then I feel very confident based on all the history I've looked at that over that 10-year period, gold will do exactly what you want it to and protect the purchasing power of your portfolio. Now, that doesn't mean you put 100% in gold. That would be crazy to do with anything. But if you want to insulate your portfolio against that loss of spending power, look at what it did in the 80s, which is again a little bit disingenuous because it had been fixed until 71 at $35. So it definitely had some kind of coil to it when it went into that run into the 1980s. But gold is not something that's going to protect your portfolio every day. It's an insurance policy that you kind of have over a longer cycle. So understand if you want to trade it or you want to own it for portfolio protection, and then adjust your kind of your way of looking at it accordingly.
Yeah, the why is always interesting. I'm always focused on the when.
There is no why. There is no why. We can get very meta when we go talk to gold.
But we got the second top ranked question is how. So instead of why, how? How do you explain gold down with commodities and inflation at multi-year highs? I mean, To me, it's really actually a simple answer. It's called Quad 2. They're really, Quad 2 pulverizes the relative strength of gold relative to the other opportunities, because in Quad 2 you can buy anything. Literally, you can buy anything, right. And that's the point. So if you understand, and it's the one quad out of four where real yields go up, and gold does not like rising real interest rates. So the best time to be long, or where I'll really pack it in on long, GLD or paper gold, I always hold my physical gold. I mean, just like my wine and my kids. I mean, they don't. God willing, everybody it all stays with me. But risk managing it really to get paid in gold isn't about just inflation. Stagflation are the best periods to be long gold, which we call Quad 3. So that Quad 3, obviously, even in 2011, you had that, and that's where gold went to its most recent all-time high. So I do think that all of our work empirically on back-tested gold against economic quads on a 2x2 model, growth and inflation, gives a pretty simple answer. Where on the shorter-term cycle and risk managing of gold. That's my. Do you have any thoughts on that, by the way?
Yeah, well, it all makes sense, but I'd just add something else in that we've just spent this last 30, 40 minutes talking about this mindset of inflation and how they're battling it to take hold. And gold going up in an inflationary environment is, again, a mindset thing. People start to think, oh, my God, I'm going to lose purchasing power. I want to own gold. Look at what the central banks are doing. Look at what we've talked about, how they're looking at all the data. We've shown the Dallas Fed showing us that OER is going to go up 7%. They're not talking about that, but that's what their data is saying. Central banks around the world are buying gold hand over fist. Last year was the biggest one-year accumulation of gold in central bank history, as far as I can remember. I think it's certainly in the last sort of 40, 50 years post-Bretton Woods. So the central banks are protecting their own balance sheets against loss of purchasing power. The public is not in that mindset yet, but it's tending to move that way. And once the public starts stockpiling canned food because they're worried about price increases, they will at that point, I'm sure, start thinking, well, how do I protect my purchasing power if the prices are going to go up? And historically, gold has always done that. So the fact that it hasn't yet, again, I think speaks to we're on that precipice of how this mindset can get entrenched. And if it does, to Sam Zell's point, if the mindset gets entrenched, I feel very confident that you'll see gold start to reflect that.
All right, we have this one. You and I could have we could actually have a whole seminar if we had Neil here. But this is a third-ranked question from Rich. Grant, as someone who knows Neil Howe's work, Neil Howe, who's my colleague, love that guy. What do you personally think of the fourth turning and where we are in that cycle?
Well, I think if you've read Neil's fantastic book, then you recognize everything we're seeing. And again, there isn't. It's uncanny. I mean, it really is. It's and for those of you who may not have read it, then Neil and Bill Strauss did just a remarkable piece of work with the fourth turning, and you can still get it. It's not that easy to buy in bookshops, but you can definitely get it online. But if you've read it, you'll. It's almost like one of those maps that says you are here, and we're right in the middle of that fourth turning. And there's no set time period. It's supposed to be roughly 20 odd years of this thing. Mm-hmm. But you will recognize it with the loss of faith in institutions and a disunified public. All the signs are there. So believing that we're in it or whereabouts we're in it is really not the point. Understanding the kind of the full fourth turning cycle. Where does the fourth turning take us? Yeah, is the thing to understand. Where does this lead to? And it leads to all kinds of breakdowns in institutions, in society. Yep. So that's kind of the path we're on. Again, it's not guaranteed that we end up down there, but all the work that Neil and Bill did set out plenty of examples of how these things ended up in wars. They tend to end in wars. And if you look around the world right now and you look at the saber rattling in the South China Sea and the Chinese flying the warplanes through the Taiwan Strait again, you can see all this stuff happening. And the reason it happens is because these cycles tend to end the same way, with massively over-indebted governments looking for a way to get out of a situation that they've put themselves into. And oftentimes that means, how do we galvanize the public around us and stop them worrying about their own individual needs and get them worrying again about the needs of the society as a whole? And the best way to do that, it's been proven over thousands of years of human history, the best way to do that is to galvanize them against an outside enemy. So, where we are in the fourth turning is to be determined by history, but understanding where the fourth turning takes society to is really important to understand, because it's generally a dark place, but it's a dark place before what is always a very bright dawn.
Yeah, it's the reset, the great reset. First, you have to go through pretty much what everything, and unfortunately we're out of time. Like I said, we could have had an entire half day on that if we had Neil here. And by the way, Neil's got I don't know if you knew this or not, but he's in the midst of writing another book, an update to that fourth turning, and I really am. I'm excited to. Like, he's obviously keeping it close to his vest. I have no idea what it's going to say on the timing of it all, but I think he's more focused, obviously, as he usually is, in terms of, again, the why he demographically is definitely something he's on top of. So, as always, like a great discussion. We went all over the place, and if everyone had to know why everything's so screwed up, we would probably say the fourth turning anyway. So, thank you, thank you for that. Thanks for your time, Grant.
I really enjoyed it, as always, Keith. Thanks for having me.
Always great to see Grant Williams. Up next, we have Mike Green.